not showing what I think it should show. Well, okay, let's look at it. Statement of cash flows, you need 4 items. Income statement, schedule of your operating expenses, which simply shows your operating expenses in more detail. Your retained earnings statement, which shows what you're doing with your retained earnings, whether you're paying dividends or what you're keeping it in the company. And then a comparative balance sheet, which we know what that is now, right? We're looking at the comparison of the two and what's happening in our assets and liabilities and owner's equity. All right, so schedule of operating expenses, schedule that supplements the income statement. And what it does is, on the income statement, remember it was condensed, it didn't show all your expenses. So this schedule means what in accounting? I remember what schedule is. No, but we had a schedule of accounts. It's a list, right? It is a list. Okay. A schedule just means a list. When you did your schedule of accounts receivable, remember in accounting 1 you listed them. It's just terminology. Okay. So it's going to supplement your income statement because the income statement is going to be condensed. It's just going to show a total operating expenses subtracted from the net income. However, the schedule is going to show where is everything going, what did we spend it for. There's a list of all your expenses, what we used to show on our regular statement. Okay, then the statement of cash flows reconciles the beginning and ending cash balances, so let's look at it. It ties together the income statement, all your changes and your non-cash items on your balance sheet. We talked about a little bit, depreciation and all that, right? And the non-cash things that happen. Changes in the non-cash items on the statement of retained earnings also, when it's taking things out of account, but no cash is being actually sent out of the company, right, paid out to do that change. And, okay, we can use the direct or indirect method. I do have a little input on the indirect method. Indirect method is what is shown in this chapter. And the indirect method prepares the statement, and it treats net income as the primary source of cash from operating, and then adjusts net income for changes in non-cash items. So we're looking at income as the primary source of cash coming in, which is usually true. And then we're going to adjust that for any of these other things that are happening that don't require cash. All right. Okay. Cash flows from operating activities are net income plus or minus non-cash items, plus decreases in current assets, minus increases in current assets, plus increases in current liabilities, minus decreases in current liabilities. In that, if we increase the current liability, we created a liability for it instead of paying cash for it. That's the logic. Instead of going out and paying cash for the supplies, we charged them. So it didn't affect our cash, right? But it did affect them. So therefore we adjust. It does get a little complicated. Net cash provided by, and I'm going to do it. I'm going to stop right here and go back because I do have a little short film clip that let's hear it first. And then let's go back to this. Because I don't want to rush through this. I want to go ahead. Really, I want to cover this next time. But right now, let's go ahead and let's play this little clip on the indirect method. This is the method we're going to be using. This is found in your content module. You can watch it again. And I need to wait just a second. I'm going to zoom in on it. And you might find other things.
I'm Larry Walther. This is principlesofaccounting.com, Chapter 16 on the statement of cash flows. And this segment is going to look at the indirect approach to preparing the statement of cash flows. A previous module looked at the direct approach. And these methods are very close, but they calculation of cash flows from operating activities. With the indirect approach is based upon essentially the reconciliation format that was supplemental to the direct approach. So rather than presenting in the statement itself, rather than presenting cash received from customers, cash paid to suppliers, cash paid for wages, and so on, we'll start with the income of the business. Here I chose to start with net income. We might start with a different measure of income in some cases, but for illustration, we'll start with net income in this case. And you can see we have various adjustments, adds and subtracts, that come up with $800,000 cash from operating activities. This is exactly the same amount that we came up with under the direct approach, but calculated in a different fashion. And so let's consider why we would be adding to the same amount that we came up with under the direct approach.
Stop it and look at it. That is net income and non-cash effects on the operating income. There's our depreciation, right? It's a non-cash, it did not affect cash, right? Non-cash effect on income. Gain on the sale of land is going to be taken out. Because that is capital gain, not created from net income, right? Increase in accounts receivable, that's going to be taken out because we didn't get the cash, right? But it showed up as an increase in our assets, right? No cash. Decrease in the inventory, that's an increase. That is an increase in our cash because we didn't have to put out the cash, right? Inventory was there. Decrease in inventory. Increase in accounts payable. Again, that increases your cash wise because you didn't have to put out the cash for whatever was about the purchase. And the purchase is showing up over here on your statement. Decrease in wages payable.
Oh, God.
That means we paid it, so it comes out of our cash. Okay. All right? So you have to think of how did it affect cash? If I incurred a liability, then it increased cash because I didn't have to pay for it out of cash. I incurred the liability to get my assets or whatever it is I got. Right, instead of your debit card. Right. You incurred a liability, in other words, you got it, but you didn't pay for it yet. Right? It increases your net cash in that you incurred a payable instead of paying cash for it. You got your equipment. You got your equipment, and you brought it in. Or you got your goods to resale, and you put them over here, but you didn't pay cash for them. That's the reason. Because we're looking at all these statements and all these assets when we're making this decision. So accounts payable would increase cash flow. Right. Because we charged it instead of the cash flowing out for it. Yeah, think of it like that. Because that is a asset that kept its value on our statement, but that money has to reduce, and I don't know, maybe I'm not thinking about this one right. The gain on the sale of the land increased an asset, right? So it went up over here on the asset side, but we can't use that cash. Yes, but it's not a flow from operation. Even though it showed up in the cash account, you have to take it out of that cash because it's not from operations or investment. That's a complicated one, but I'll look at this up too. I'll look more into that one because that one kind of got me a little. Not for operation purposes. I'm gonna have to look that one up because that one's got me a little baffled too. Yeah, me too. But then I'm That is confusing. Now it says some income statements result from adjustments in the long-term assets. They do not involve cash inflows or outflows in the current year because so they are either added or subtracted from net income. That's all they're going to tell us about that. And that includes a sale or a purchase. So that's the only thing I see on here of that. And it's not really very specific. There's one example right there on the bottom page, but still that's on equipment, not your land, which is your see, it's talking about income statement shows a gain of $4,000. What happened was when we sold that equipment, it shows at the bottom as other income, right? And it shows a gain on the sale of equipment. There it says the proceeds, the entry was made and it did go into cash, but the sale of equipment is not part of your routine operating expenses. You see that at the top? That's the reason, which is what I thought, but it's still not real specific. It's not an actual part of your routine operating expenses. Operating activity. So the gain is a part of the $8,000 that was received from that asset sale. However, it was all included. Therefore, it's necessary to remove the gain. Okay, right? In arriving at the net cash inflow provided from operations is what we're looking at. So you have to take it out because it wasn't part of it. Because this is not right. Exactly. That's exactly it. Even though it's kind of because it is not a normal occurrence and it's not something we can count on, right?
So how's the loss on the day?
A loss on the sale would be added to net income because the loss had been subtracted from net income on your income statement at the bottom, and we needed to go back up to operations. So we had to add that. Shows up at the bottom and it's not part of your operations. And what the cash flow is based on is the operations. Okay. And not, this is kind of considered an extraordinary event in accounting in that it's not something that happens all the time.
So it was,
So we can't use it.
cash flow increase.
Can't use it as our normal cash flow statement because the normal cash flow statement we're looking at, we're planning on using that statement. We're using that cash flow to plan how we're going to budget and maybe buy things or, sell things. So anything like that is not part of your normal operating. So just think in terms of normal operating. If it's something that doesn't happen all the time, we're going to adjust it out. Make sense? Yeah, that's what I kind of thought that when it said land instead of just saying something like equipment or something, I thought. But that's what it is, yeah. Okay. So that's good thought, good discussion. Exactly, yeah. Then it was up there in your operating expenses, right?
But calculated in a different fashion. And so let's consider why we would be adding and subtracting things to come up with operating cash flows. If we look at depreciation expense of $120,000 here, recognize that that is a non-cash expense. Depreciation is a calculated amount. From a journal entry point of view, we debit depreciation expense and credit accumulated depreciation. There's no cash moving in that case, but it reduces net income. So in that sense, depreciation reduces income, but it doesn't use up any cash. Hence, we would need to add it back as one specific example. So I say depreciation is added back to net income. It reduced income, but did not consume any cash. If we look at the gain on sale of land that I've included, it's being subtracted, and that may seem odd. You may say, well, wait a minute, why are you subtracting a gain? Well, for one thing, the gain increased income, but it's not related to operations. This is an operating activity section, and so the only thing in net income related to the sale transaction is the gain in this case, or it could have been a reduction for a loss, but we're trying to essentially purge it from the operating activity section. So we would subtract the gain or add back the loss. That divorces avoids the operating activity section of any measures related to this transaction. However, the furtherance of this transaction is to consider that the total amount of cash that was received from the sale is reported as an investing activity, a cash flow from an investing activity. We discussed this in the last module, but I'll restate it here. Consider this: if you sold your car for $10,000, and let's say your car had a cost of $7,000, you would have had a $3,000 gain on that car, but it would have generated $10,000 of cash. All you want to measure in the cash flow statement is a total of $10,000. That would be reported in the cash flows from investing activities section as a $10,000 inflow. We would not also want to include the gain in the operating activity section because we would be in essence double counting part of the transaction. Let's think about increases in accounts receivable. There was one of those in the particular problem, and we subtracted it. Why would we subtract an increase in accounts receivable? Very simply, it represents sales on account that have not been collected. Sales drives up income, but until we collect the receivable, we have no cash. So we'll need to subtract an increase in accounts receivable. Conversely, we would add back a decrease, supposing that those receivables were being collected in a subsequent period without any further effects on income. Other adjustments, we have a decrease in inventory that's added. It's a bit more complex, but we can state it very simply. It represents cost of sales that are generated from existing inventories, not through the new purchase of additional inventory. Increases in accounts payable are added. These are essentially expenses that we're not paying yet. Decreases in wage payable was subtracted. These are essentially cash outflows to pay wages that were expensed or accrued in a previous accounting period. And so there are many other scenarios I could cite where we could have potential adjustments, adds, and subtracts. But this grid might prove helpful in having you think about this. For our current assets that increase, we'll generally subtract those. That would be, for example, if we had an increase in accounts receivable. It represents, again, sales we have not collected, so we'll subtract it in reconciling income to cash from operating activities. Conversely, current assets that decrease, we add. And when we go to the other side of the balance sheet, current liabilities that increase are added, and current liabilities that decrease are subtracted. So as you do your homework and examination questions, if you can reconstruct one or two and build your grid up and then use those to kind of help you remember, how it flows, it's always a converse effect, whether it's increase or decrease or current asset or current liabilities. Very helpful little tool to get you through the problems with all the right adds and subtracts. Now, let me speak about the indirect approach. We've seen the reconciliation of income to cash from operating activities. The statement of cash flows can be prepared under a direct approach, which is the recommended and preferred approach under the accounting standards, or an alternative indirect approach, which at this time more companies still use an indirect approach by a considerable margin. Some companies don't have the information systems to allow them to accurately get to a direct cash flow statement. Other companies argue that the direct cash flows can be misleading. If you're a financial institution with a lot of cash inflow and outflow, it may not be reflective of the approach. Might be a better presentation, or viewed as a better presentation of the information that describes the cash flows of the entity. Anyway, when an indirect approach is used, under the indirect approach, the operating cash flows are presented as a reconciliation of income to cash from operating activities. And here's a statement of cash flows. Here is the first section, the cash from operating activities. We have the net income plus and minus the various adjustments. This is what we saw in the earlier slide, the $800,000 net cash provided by operating activities. The cash flow from investing activities is identical to what it was with the direct approach from the previous module, as there's the cash flows from financing activities. Lastly, though, when you present an indirect approach, there's one additional disclosure requirement in the United States. You have to supplement your indirect approach with cash paid for interest and cash paid for taxes. Essentially, those are direct approach presentations of the amounts paid for interest and taxes, supplemental to the primary cash flow information under the direct approach.
Make this business. Good video, guys. So, alright. Alright. And we are using the indirect method, so that means we're going to keep the top section is going to show from operating, and then we'll show our indirect, that would be from our investing. And let's see. Let's look at we're running out of time, but so now we understand this one, right? Better? Okay. Okay. Alright. Why they affected the way they do. Because we're looking at only operating. These things affect it differently. Alright. And the non-cash items on our income statement include, open this up a little wider. She can't see, y'all can. Depreciation expense, we understand why, because it's on paper, right, no cash. Amortization is just the same thing as depreciation, only it's on a bond. It's a different, physical things depreciate. Money that's just got to be amortized back is not depreciated, it's amortized, or allocated, in other words. Okay, just different in wording. Gain or loss on the sale of equipment, because it's not a operating expense, right? It go down there in that investment part, the next section that we're going to probably talk about. And land or something like that, which would be your long-term assets, right? Okay, operating assets and liabilities. What is that? Yeah, it's not a current. Okay. So on our operating section, we're going to be looking at the current assets and current liabilities. Because this is what's coming in and out on a routine basis. These are all within a 1-year time frame. So when we make our plans or look at what our cash flow is doing, we would definitely want to look at these. Gives us the liquidity. We can do our ratio and determine the liquidity of our business that way. Right? Okay. More sales on account were recorded than were collected, which means we didn't get the cash for those accounts receivable. Hadn't received the cash yet, so thus we reduce on our cash flow, subtracted from our income from operations, even though we're believing we're going to get it, but right now we're looking at what is actually coming in. That was okay? Prepaid expenses. More was charged to prepaid than was paid. So it's added because cash didn't go out. It was already prepaid, right? We're just allocating that expense, sort of like depreciation. Okay. More supplies were paid for than were used. So when we do that adjustment, remember, it's an adjustment. It's not a cash transaction. We just adjust what we've already bought. Okay. Supplies. That's when you do your buy your supplies for your business. Remember, and then we go and say, go to the supply room, look at the end of the month, see what we've used, and we do our adjustment on supplies. I don't know what page that would be on. Decreases in prepaid is not easy out. We're just looking at supplies. It's right there under the little yellow box. Right? Okay. Decreases in non-cash current assets are added to it. Inventory is one of our non-cash current assets. That's go back. More inventory that was sold out. In other words, we're selling it out of our inventory that we've already purchased. And it's reflected as cost of goods sold, but cash was not used to replace it. So the changes in it are not. So net income is going to reflect higher costs than the actual cash that had to be outflowed because we already had the inventory to sell. Right? So a decrease in inventory is added to current liabilities are added to net income, because we didn't have to pay the cash out, right? Okay. And whereas decreases are subtracted. Okay. Here's our little summary. I hope they gave you a summary, sort of. Yeah, there is. And we're going to take our time on this, so don't panic, anybody. We're just going to do some of these. I saw everybody. I know. Yeah, it's confusing. Net income, deduct from net income and decrease in the current added. Okay, we'll do some more of this. First line of the statement of cash flows is a net loss. If our income statement is showing a net loss, then we just adjust accordingly. Same logic, same procedure, whether it's showing income or a loss on our income statement. Okay, so that's section 2. So here's what I want you to do. We've got to get out of here. The class coming. I want you to do exercises. Exercises. Go ahead and do all these. Go ahead and work through these exercises. Just the exercises. Under 24, we're going to do 1 through 5. Exercises 1 through 5. And think taking it one little blurb at a time, like exercise at a time, will help you understand it. And I am going to, I have a note right now, to add the solutions to chapter 24 into your content module so you can check it. Okay. They won't print from the content. I can't fix that. But I can put it in there for you again. Do y'all want the slides? Okay, let me make myself a little note, then I'll put them in the content module. Okay, I'll check, I'll do that.